You are listening to ChartingWealth.com's weekly review and forecast for the week beginning Monday, the 22nd of February, 2016. We always start with a weekly chart, and we always start with IYY. This is the way we'll do it. We'll go through what happened on the weekly chart, where it is, what happened daily. We'll go through our three indexes, the total market, the S&P 500, and the NASDAQ 100, then gold. Then we'll jump into what affected the market over the past week and what's going to be coming up in the next week. Okay, IYY, total market. Our market rotated over going down back on the 31st of December. Opened up the year with a bang and huge down moves. Then slid sideways on the week ending the 29th of January, the 5th of February. Then a big drop over the week ending the 12th. And then over the past week, bit of an up move, but the up move has not been near where the down move started on the 12th, and that is for the week ending on the 19th of February, this Friday. So what do we have going on? Well, we have a bit of a green open box for the first time in many, many weeks. We have the derivative oscillator losing some of its downward momentum, and we do have what appears to be the MACD, the moving average convergence divergence line, approaching the signal line, but no crossover going up yet. Actually, just a market that's been sliding sideways and dropping again. 1 week does not make a trend. It has not occurred. We are still in a confirmed down move on the big chart, the weekly chart, which is the biggest chart we look at. Now let's see what happened intra-week. What happened during the week on the daily chart on Monday, let's see, Monday the 16th, forgive me. What we saw happen, I'm sorry, that's Tuesday. That's why I was confused. We had a holiday, right? Markets were closed. So Tuesday the 16th, we saw the market zoom up. Same on the 17th. The 18th, it started losing some of that momentum. And then on the 19th, what happened with the total market? It's sort of, I would say, a spinning top there. We sort of had it not do much. In fact, for the last day of the week, the market was actually down 0.03%. Still above our two-day trend line, but the derivative oscillator is still continuing to gain speed, and we don't have the MACD coming together, so we're in a confirmed up move on the shorter daily chart, confirmed down move still on the big chart. That's where we are. We are just sort of hanging out, not hitting anywhere near the highs over the prior 2 days, the 17th and the 18th. We've got the market digesting some of those gains, but still in a confirmed down move on the big chart. So again, how long do the down moves take place? Well, if you've got a crossover going down on your big chart, and that is the weekly chart, it typically moves in that direction for a few weeks, which it's been doing. Till it crosses over going up, we're still in a confirmed down move. Now let's quickly jump over to SPY, the Standard & Poor's 500. Again, this is an index fund that tracks it. We see it crossed over going down right at the beginning of the year, just like the total market did. Slipped sideways the week ending the 29th of January, the 5th of February. Big down move with the week ending the 12th of January, and then a bit of an up move. Again, not as high as the down move started on the 12th. And that is for the week. That up week was this past week, the week ending the 19th of February. So confirmed down move, although we do see a convergence, a coming together, not a crossing yet, but it does appear that the MACD is getting closer to the signal line, and the derivative oscillator, as depicted on our charts by a red light box in the background when it's in the negative as it is now, a green box in the background when it's in the positive, it's still in the negative. If we drop back to our daily chart and see what happened during the course of the week, we see on the 16th, the chart rotated over going up, and then the following day on the 17th, the derivative oscillator rotated over to match the MACD. Big up moves on the 16th, 17th, not as much on the 18th, and then sort of a sliding sideways down day, 0.05% on Friday. So again, sort of tracking what's been going on with the total market as far as the SPY. Now let's go back to our weekly chart and take a look at the Qs, which is the NASDAQ 100. Still in a confirmed down move. Derivative oscillator also losing a little bit of downward speed. sliding sideways. Again, an up week technically, but not much. So what shall we do? We will drop back to the daily chart, take a look. The market ended the week technically up 0.30%. It moved up strongly on Tuesday and Wednesday, not as much on Thursday, and then again that weaker day on Friday, still in a confirmed up move on the short chart, the opposite, of course, of the long chart. And we're just continuing to follow. Derivative oscillator continued to heat up, even though the market was pretty much sliding sideways on Friday above the 2-day trend line. That is where we are. We've got the market schizophrenic on the big chart down, on the small charts up. So continue to watch for the market wanting to head down until and unless this up move on the big chart is confirmed. Always keep in mind what the big trend is. It's the big wave that affects all the little waves, even though they might be trying to build and go up. Till there's enough of them, they're still going to be pulled down by that big wave. Okay, lastly, let's take a look at gold. On the weekly chart, we see that gold crossed over on the 8th of January, moving up. It's always nice when you see the derivative oscillator and the MACD cross over about the same time. Gold tracked along nicely, really over the week ending the 5th and the 12th. Lots of huge up movement. The up movement over the course of the past week was simply, it didn't really hit much higher highs than it did the week before, just barely a little bit higher. Ended actually Friday when we go to look at our intra-week, that is the daily chart. The 16th was a down day for gold, 17th an up day, but didn't even match the down movement on the prior first trading day of the week, Tuesday. So Wednesday was an up day. Then Thursday, an up day, as was Friday as far as the Hinki Ayashi. Technically, it was down 0.6%. Derivative oscillator losing energy. And when we look at the MACD, looks like it's getting ready to cross over, going down. Now, again, it has been a confirmed up move on the daily chart since the 19th of January. But the derivative oscillators lost a lot of speed, something to really pay attention to. Typically, we don't give a lot of shrift to the derivative oscillator, but it sure lost a great deal of energy over the past week. So we'll see if gold has petered out, at least on the daily chart for the time being. Still in a confirmed strong up move, of course, on the weekly chart. Now, that is where we are as we've ended the week, so we know where we stand. Big charts are down on our indexes. Big charts are up on gold. And remember, the market tends to move in the direction of the big charts. You'll have some fluctuations, but until those fluctuations on the smaller charts are of significant nature, those charts are going to tend to go in the direction of the big charts. Now, let's go and talk about what happened over the course of the last week. We saw a number of things come out. Saudi Arabia and Russia had proposed crude production caps. Iran rejected that measure. And what was trying to go on? Well, global equities had rebounded moderately in the week, boosted by an early rally in crude oil, but then hopes on that agreement did not occur. They faded as the week went on, and so did the rebound in crude, so did the rebound in stock prices. So keep that in mind. Continue to sort of see how what you hear about oil prices affects the stock market. We also see other things occurring, particularly in Europe, with the European leaders gathering in Brussels on Thursday of this past week, trying to deal with negotiations to prevent the UK from exiting the European Union. Now, that'd be a huge blow to the European Union. See how that will play out. Looks like there might be a referendum in the UK on the 23rd of June. Continue to sort of keep that in the back of your mind. Now, the ECB, the European Central Bank, their leader, Draghi, has been talking about the ECB doing its part to spur economic growth. Now, Mario Draghi told the committee in the European Parliament on Monday that if inflation weakens further, that the bank will not hesitate to act. Now, the Fed, our own Fed, the Federal Open Market Committee members actually released their report from January saying that it would be premature to change their outlook for the U.S. economy, but they went on to add that they were going to continue to closely monitor global economic developments. They're going to keep looking at stock prices and at oil, and they discussed altering their views if there are problems that show up as far as their target range for the federal fund rate. What does that mean for investors? Well, the market is thinking that further tightening is not going to be expected at least until well into 2017. And remember, how much is the market affected by free money? A lot. Doesn't seem to be all that concerned about, wealth increasing or any other things. It seems to be more concerned about free money being pumped into the banks than anything else. Let's talk about Japan. Their fourth quarter GDP contracted in Japan pretty significantly. It shrank annualized to 1.4% in the final quarter. They saw a slump in consumer spending that led to the decline. Corporate profits fell something like 10%. The U.S. labor market has continued to hold firm, even with all the market gyrations and crazy things going on with the downturns. Large-scale layoffs have not yet occurred. What else do we see happening? Oh, the UK, they've seen their retail sector soar, and earnings are now moving sort of into the home stretch as far as their impact on things. What's been going on? 78% of the S&P 500 companies' earnings have already been reported, and overall about a 4% decrease, but in the positive territory when the energy sector is involved. So again, we'll continue to pay attention to those things and see if any headwinds come up. Not so far. Now, let's look at what's going to be going on over the course of this next week. On Tuesday, the German GDP is going to be released. On Tuesday also, the IFO is going to release its Business Climate Index. Again, not a whole lot really market moving. Thursday, you're going to see the Eurozone CPI is going to be released. Sort of see what that has. And U.S. GDP is going to be released on Friday, revisions to fourth quarter GDP. So we'll continue to watch and see. Again, no big Fed moving market news. But again, keep your eye out and just sort of see how things with oil, that seems to be something that's affecting the market a lot. See what's really going on there and how that might be affecting things. But we thank you so much for joining us with this weekly review and forecast. Hope it's been helpful to you to understand where the markets are, where they may be going, what affected the news last week. Not really a lot of market moving news that we can look for at this point for the next week. Some weeks we can, like we could last week with the Fed coming out with reports with all that was going on in oil, but continue to pay attention to oil and just see what its impact is on the markets. Thank you so much for listening. You have questions, concerns, problems, issues, we like to hear from you. All you have to do is go to chartingwealth.com and let us hear from you. Follow us also on Facebook, Twitter, Instagram, YouTube. We're here for you. Let us hear from you. God bless. Hope you have a great week trading and investing from chartingwealth.com.